Hi everyone. Today I'm going to go over how to read this chart, and it's a chart that tracks the price of an options contract. And I'll go into how to read it, but first remember options are tracking and representing the underlying share. So if this option is YMAX $12 put, it's representing 100 shares of YMAX. So just give us some context. I'm going to click in this top right corner saying view YMAX. So this is the stock. And we can look at how it's been doing for the past month, kind of bouncing around there. We can see it's bouncing around between $13 and something, $14. Past 3 months, started about almost to 15, dropping down to 12 something, bouncing back up. So, your typical stock prices of how that's looking. So we go back. This particular put, $12 put of YMAX, this has an expiration of June 20th, and today is June 3rd. So it's expiring less than a month. And our chart, we're looking at a bar chart. Let me just widen our timeline here to 1 month. Okay, so you can see this with this candlestick charts. We on May 5th, the open was 18 cents, the high was 18 cents, close 15 cents, and the low was 1 cent. So what that means, it opened up at 18 cents at the start of the day. It closed at 15 cents, so it went down a little bit. The lowest it was for that day was a penny, and its highest was its opening. And it's a red bar, which means that it started high but ended lower than when it opened. So these red bars means that they closed lower than what it was at the start of the day. And the opposite is true. This green bar means that that it closed higher than when it opened. Did I say that right? It closed higher than when it opened. Yeah, so basically red means that price is going down, green means it's going up. And this is a better context for this chart. So this put option was listed on April 17th, 2025. It expires 2 months later on June 20th, 2025. And the reason this price is higher for this contract right off the bat earlier on, and see how it declines over time, is because time decay is baked into that price. Because if something's way out in the future, there's a lot of uncertainty associated with it, and so it's more valuable to us who don't know what's going to happen. Is the price going to go up? Is it going to go down? And as that deadline approaches, as 6/20 approaches, we become more certain that this stock isn't going to move around as much. It's really hard for a stock to swing wildly by huge percentages the closer it is as we get to that expiration date. We're more certain of the future of where the stock's going to go. I mean, not totally, but most of the time, it's not going to swing wildly. So that's why over time, uncertainty makes this more expensive. And then as we get more certain, as the price becomes more into view, more into focus, as we get closer to the expiration date, then we're more certain, okay, this price isn't going to swing around really wildly, so therefore this option isn't going to be worth as much. So that time decay is baked into that price. So just a reminder for what exactly is a put. Let's say from our perspective, we want to sell the $12 YMAX put, which means if we sold that put, that means we're saying we expect the price to not go below $12. But if it did, and you can see up here, that little red thing brings you the stock price. Right now it's at $13.72. So we would believe that this price would not dip below $12, but if it did, we would be forced to buy 100 shares at the $12 strike price. So we would have to purchase $1,200 worth of the YMAX stock. So we would sell that put for a certain price. And that price is whatever this chart says. Now, if we're selling a put, someone on the other end has to be buying that put. So let's say we sold the $12 put. Someone on the other end is buying the $12 put. From their perspective, they're thinking, oh, I'm hedging my bets with this stock because I own 100 shares of this stock. And if I buy the $12 put, that means even if it does dip below $12, it's okay. I could exercise that put and force someone else at the other end of the deal to buy those shares, buy 100 shares at $12. So let's say the stock price dips to $11 and they exercise that put. Not only then they're okay because they're making you buy it for $12 a share. And if they didn't do anything with options and they were just controlled 100 shares of that stock, they'd be out $1 per share if they sold it at $11. So it's kind of like insurance to them. If it dips below $12, it's okay. They know that they could just exercise that put, get $12 a share for it, and get out of that stock. So that's why they're buying kind of like that insurance. So they're paying you money to take on that risk. And on our end, we're selling that put, we receive a little bit of money, and we either have two lines of thinking where either A, we want to get into the stock anyway, and if it goes to $12, great, that's the price we wanted, we'll buy 100 shares of it. Or your other line of thinking may be, oh, I hope it doesn't dip below $12 because I just want to capture the premium and get paid to hold on to that risk for a little bit, but not actually get into the stock. But that risk is always there because they could exercise that put at any time they want, forcing you to buy it at $12 a share. So just keep that in mind. So with this chart, you can see that right off the bat, April 17th it listed, the future is very uncertain. And so we have these high prices of $1.45. But as time goes on, say on May 1st, we see that the price is around 45 cents a share, but it could be lower because there's quite a wide range there. And so someone getting into or out of this deal, like around this time, May 5th, could be paying, say, 15 cents a share, from where one perspective, if you sold the put, you would receive 15 cents a share, which times 100 would mean you'd get $15. Or from the other end, someone buying that put would put up $15, and that would be their insurance on their 100 shares, just in case their stock dips below $12. As you can see, as time goes on, we near the expiration date of 6/20, then that underlying stock price becomes more certain, and that's why that value decreases. And that's how you read that chart. Thanks for watching.